There's a number, updated every second of every trading day, that most people never think to check. Not the stock market, not interest rates, the price of a barrel of oil. And whether you track it or not, that number is quietly shaping the cost of your groceries, the stability of governments, and the direction of the global economy right now. It has triggered more recessions and financial crises than almost any other single variable in modern history. And somehow, it never gets top billing. That changes now. Before we get into the history, we need to establish something first. Because if you don't understand what makes oil structurally different from every other commodity, none of what follows will fully land. Oil is not the same as other commodities. It is structurally different because it is embedded in virtually every layer of the modern economy at the same time. It powers transportation, every plane in the air, every ship at sea, every truck on the motorway runs on petroleum. It's the feedstock for plastics, fertilizers, pharmaceuticals, and synthetic materials. It heats homes across the northern hemisphere. It generates electricity across dozens of countries. Without oil, the modern logistics chain does not slow down. It stops. And here's the part that matters most for everything we're about to cover. When the price of oil moves, it does not stay in the oil sector. It travels. If it costs more to ship grain, bread gets more expensive. If it costs more to run a factory, goods get more expensive. An oil price increase is not an energy story. It's an everything story. And I mean that literally. Not in the way people online say literally when they mean sort of. Economists call this a supply-side shock. In plain English, a sudden event that disrupts the ability of businesses to produce at their normal scale. The outcome is an economic disruption. Which means by the time ordinary people feel it, the price has already worked its way through the entire production chain. There is no early warning system. You just wake up one day and everything costs more. And the explanation is buried somewhere in a commodity market most people never watch. That is not a design flaw. That is just how deeply oil is wired into the architecture of the global economy. If that just changed how you think about oil, subscribe. And history has stress-tested that architecture repeatedly. The results are not encouraging. October 1973. Egypt and Syria launch a coordinated military offensive against Israel. The United States and several Western nations back Israel with material support. In response, the Arab members of OPEC, the Organization of the Petroleum Exporting Countries, impose a full oil embargo on the United States, the United Kingdom, Canada, Japan, and the Netherlands. Crude oil prices moved from roughly $3 a barrel to nearly $12 in a matter of months, a 300% increase. In today's terms, that is the equivalent of oil going from its $73 a barrel price in February 2026 to $292 per barrel within a few months. Except in 1973, the global economy was far more oil dependent and far less diversified. There was no cushion. The consequences arrived fast. In the United States, petrol prices surged and fuel rationing was introduced. The national speed limit was lowered to 55 miles per hour, not for safety, but to conserve fuel. The New York Stock Exchange lost over 45% of its value between January 1973 and December 1974. Unemployment climbed, industrial output fell. And then something happened that genuinely broke economic theory at the time. The United States entered a period of stagflation. That means the nation was experiencing economic stagnation and inflation at the same time. Prices of things everywhere were rising while the economy contracted. That combination was not supposed to be possible under the prevailing models. The 1973 oil shock did not just damage the economy. It invalidated the framework economists were using to understand it. Imagine being an economist in 1974, watching your entire model do the one thing it mathematically said it could not do. Rough day at the office. And the damage was not confined to America. The United Kingdom entered a severe recession. Japan, which imported almost all of its oil, saw its post-war economic miracle stall for the first time in 20 years. Global GDP growth dropped sharply across every major industrialized nation. One price, one commodity, and the entire architecture of the post-war global economy buckled under the pressure. Surely the world learned something from that. Surely it built something more resilient. I think you already know where this is going. 1979. The Iranian Revolution overthrows the Shah and devastates Iranian oil production. Output falls by roughly 4.8 million barrels per day. Prices more than double, moving from around $15 to over $39 a barrel. Now, if you're keeping score at home, and you should be, because the pattern is the entire point, here's what happens next. Recession. Inflation hits 13.5% by 1980. And Federal Reserve Chair Paul Volcker, facing an economy coming apart under inflationary pressure, makes a decision that is brutal in the short term and necessary in the long term. He raises interest rates to over 20%. A mortgage at 20% interest more than doubles the total cost of buying a home. That was the medicine required to break the inflation. The patient survived. It was not a comfortable recovery. Think of it as financial chemotherapy. Effective, but not something you would describe as pleasant. Then, 1990. Iraq invades Kuwait. Markets do not wait for analysis. Oil prices spike from around $17 to over $41 a barrel within 3 months. Same sequence as 1973. Oil spike. Transportation costs rise. Broad inflation follows. Spending falls. Contraction begins. 17 years later. Same playbook. Same result. At this point, the global economy is basically stepping on the same rake, in the same garden, and acting surprised every time. Then, 2008. And this one needs to be handled carefully, because the financial crisis had real structural causes. Subprime mortgages, derivatives exposure, institutional failures. All of that mattered, but here is what often gets left out. In the first half of 2008, before the full collapse, oil prices surged to an all-time high of $147 a barrel. Consumers who were already over-leveraged were now being squeezed by energy costs. Businesses already under pressure were absorbing rising input costs across the board. The oil spike didn't cause the crisis on its own, but it acted as an accelerant on conditions that were already unstable. The subprime crisis built the bonfire. And you know what happens when you put fire to oil. 5 decades. 4 major shocks, the same chain reaction each time. So the question is not whether oil breaks things, it's who benefits when it does. Now, here is a question that actually matters. If oil shocks cause this much damage, who comes out ahead? First, oil exporting nations. Every price spike is a direct transfer of wealth from importing countries to exporting ones. The 1973 embargo flooded OPEC member states with revenue. Saudi Arabia's oil income increased roughly tenfold between 1972 and 1974. The sovereign wealth funds, the skylines, the geopolitical leverage you see today. All of that traces back to decades of being on the right side of price shocks. Second, the major oil companies. When crude prices rise, production costs don't increase at the same pace. Margins expand. If you look at earnings during any major price spike, the numbers are, to use a technical term, absurd. 2022 was a recent example. While households across Europe and America were rationing heating, several oil majors posted the highest profits in their history. Third, commodity traders. The people who trade oil contracts thrive on volatility. A stable oil market is a boring oil market. A chaotic one is a profitable one. The worse things get for everyone else, the more opportunity exists for those trading the chaos. The losers? Everyone who buys things. Which is, and I want to be precise here, everyone. And if that pattern sounds familiar, it should. The people who understand the system position themselves. Everyone else absorbs the impact. That pattern should sound familiar by now, but the reason it keeps repeating is structural. The reason that this keeps happening comes down to 3 structural realities that have not fundamentally changed since 1973. First, concentration of supply. A large share of global oil production comes from a small number of countries, many of which are geopolitically volatile or operate within coordinated groups like OPEC+. OPEC+ controls roughly 40% of global output and an even larger share of reserves. That means supply decisions are often political. When production is cut or disrupted, the market cannot adjust quickly. The price just moves. Second, Inelastic demand in the short run. This means the demand for a product does not react to the price changes. If oil prices double tomorrow, you cannot stop commuting next week. Airlines cannot ground fleets. Shipping companies cannot switch fuels overnight. Demand barely moves, which means the full impact passes directly through to consumers. No buffer. Third, the dollar connection. Oil is traded in US dollars, so price changes affect currencies, trade balances, and central bank decisions across the entire world at the same time. When oil rises, importing countries see deficits widen, currencies weaken, and policy tighten. 3 features: concentration of supply, inelastic demand, dollar pricing. Together, they lock the global economy into dependence on something it cannot quickly replace. Not a conspiracy, just plumbing. And once you see the structure, you cannot unsee it. Which brings us to the part most people assume has already improved. At this point, it's reasonable to think things have improved. Renewables are growing, electric vehicles are scaling, diversification is happening. That is all true. The world is less oil intensive per unit of GDP than it was 50 years ago. Solar, wind, natural gas, and nuclear have reduced oil's dominance in power generation. These are real changes, but global oil consumption is still around 100 million barrels per day. Transportation still runs overwhelmingly on petroleum. Petrochemicals remain foundational to manufacturing. And the fastest growing economies are increasing their consumption as they industrialize. Demand isn't disappearing, it's shifting. We saw this clearly in 2022. Russia's invasion of Ukraine sent oil and gas prices surging. Europe scrambled for supply, inflation spiked, central banks raised rates aggressively. A cost of living crisis followed. Same pattern, different decade. The transition is real, but it is slow, expensive, and politically complicated. And that gap between intention and reality is exactly where the next shock will emerge. Every time you see oil prices move sharply, you are not watching an energy story. You are watching the beginning of an inflation story, a monetary policy story, a trade balance story, and sometimes a recession story. The trade happens in a market most people never see. The consequences show up everywhere. The price of oil has never just been about oil. It has always been about everything else. And until the global economy can function without it, that will remain true. The shocks will keep coming. Now you know why. If that just changed how you think about oil, subscribe. Covering topics like this is what I do.